Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome back to the video. In this one, we're going to be going over what I like calling the morning drive, which is a really strong drive out of the gates, but more so specifically the trap continuation that occurs when you have a morning drive. Now, what is it that I mean by morning drive, right? What the heck is that? Generally speaking, when the market opens up, it's 9:30 Eastern time, at least in the East Coast side of things here. And when the market opens up, if it's going to go sideways, usually it's going to start off with bull bar, and just kind of go sideways. But every once in a while, in fact, the odds are 20% of the time, or one time out of the week, usually, there will be the first candle of the day, which ends up creating the high of day or the low of day. And when those types of situations happen, which again only happen about 20% of the time, but when those types of situations happen, they create a very reliable follow-through scenario that you can pretty reliably count on. So as an example, we start off with a downward gap from close into the open. And from there, we have a bull bar up leading into an inside bear bar. And that's the important part here because we did not break a new high, right? Didn't break a new top. We have an inside bear bar, which broke another bear bar that went down again with another bear bar and again with another bear bar. And there is a bull bar, but it never broke another candle's high and then broke another bear bar. And by this point in time, you've got, if you were just counting the first 5-minute bar, you've got 1, 2, 3, 4, 5, 6, that's another inside bar, 7, 8 candles straight down, and a couple extra in there, that haven't broken a previous candle's high. And that right there is what I love looking for a continuation. It's one of my absolute favorites. But there's a little bit of a caveat here, because when you're looking for the continuation, the more extensive the drive to the downside, the better, the more likely it is to continue, but at the same time, the more risk you're going to have to take on, because realistically, your risk is going to have to be up to some kind of break point, and if these candles are getting real wide, that break point becomes very expensive. But here, as an example, while we're driving down, sellers are going to look to sell above the previous, in this case, it's a bear move down, so the previous bear bar's high. We've got the last bear bar, which is the first one that I want to look at, and then the next bear bar, the last two. Those are the big ones that I really want to keep an eye on as zones of resistance. They never made it up to the second one, but the first one tried holding as resistance, and if you were a scalper, that would have been all you needed for a quick little pulse to the downside and a one and done, easy peasy. Now, as far as the continuation phase goes, you'll notice they went a little bit further. And in terms of structuring the trade, we have to be realistic. This is a scalp style trade. High risk, low reward, high probability. That's the point of it. So when we're looking at this type of scenario, we know that sellers are going to be selling above the previous bear bar's high, but where is their initial stop going to go? Right? What's the initial risk on the trade? Well, realistically, the only swing that we have would be way the heck up here. So their initial risk is going to be way up at the top. Now, is that a risk that I would be comfortable with? No, of course not. Would the market hopefully give us plenty of opportunities inside of there to exit way before something like that happens? Yeah, hopefully, But this is what I would consider a catastrophic initial stop. If the market goes crazy, some news comes out of the White House, something happens, whatever, that's a protective stop to protect you from something crazy happening. It doesn't feel like protection if you take a $1,500 ding, but you know what I mean? It's a lot better than, a $70,000 account blow up and all of a sudden everything's gone because some crazy news announcement. These are safety measures. But with this initial measurement, they're going to be looking for a continuation basically straight down for a scalper's objective. And you'll notice the scalper's objective is right down here, but I want you to take note of something. Remember, this is a very wide target. We're talking a monstrous objective to the downside. So when we're looking at this big of a continuation and you get a couple more bull bars that are closing above, you also have to remember that the type of traders who are taking this kind of risk aren't one contract traders more often than not. More often than not, these are traders who are building into 5, 10, 20, 100 contracts, 200, 500 contracts, maybe even thousands. So building into this kind of position isn't going to hurt their feelings. And when you're looking at it from that perspective, we have to understand what is the actual risk scenario, because that is one of the most likely objectives that the market is going to push to if it's ahead of the major overall objective. The major overall objective being this target down here, rather, with a 0.5 to 1. But if we go across here and we say, well, if the seller's just sold above the previous bear bar, and it goes up a little bit, only 1 tick, goes up a couple ticks, not that big of a deal. And again, if we're playing it realistically, if you're looking at a 2 to 1 actual risk, just so we can see it, they didn't technically fill it, right? So if we're looking at the top of this candle, when the market came down, they did not get a 2 to 1. So it's still open. We go up to the next candle. Obviously, they did not come anywhere near a 2 to 1. And when we finally rotate above the highs, you'll notice that the 2 to 1 objective is, in fact, ahead of the 0.5 to 1 scalp, which is where the majority of contracts are going to get taken off. And it's no surprise that that was the low of the rest of the day. That's where all of the continuation sellers were looking for. They have their major objectives. And if they were looking to take off, let's just say, as an example, they have 100 contracts and they take 80 off here and they're trailing 20. Gets back to break even. Maybe they sell another 10, so now they've got 30 short. Take a couple of those off on the next push down, but see if they can break through, and it doesn't. Gets back up, looks like it's going to go down. Oh, now we're back up to break even? Nah, I'm just going to scratch them. There may be some more sellers that try to take it, but as soon as it closes above, back down, back above, you can see they're starting to exit very quickly, and they're in a panic trying to get out of the way. And that's why I love looking at these for the short term, not being greedy. Look at whatever the nearest target is, 2 to 1, 0.5 to 1, larger scalp, whatever, but the major objective to get filled and then done. And really the prerequisites are really straightforward. You're just looking for a really, really strong move. And then for that strong move to continue. Now this happens all over the place, but I like looking for it right out of the gates. Here's another great example. We start off with a gap up and it gets absolutely annihilated to the downside. My first thought process is, find me a spot to sell, please, right? So we sell above the previous bear bar and we look at the overall highs at the top. Now remember, this is one of those that actually didn't pull back against them very far, and because of that, they didn't have to use the 2 to 1 objective. So where did the market go? It made it down to their 0.5 to 1 objectives. Where did that put the bottom of the market in for the better part of 2 hours? Right at their objectives, right? These things happen over and over and over again with enough reliability to pay attention to, and definitely something that is on my radar when we have an incredibly strong drive. Here's another one, and then we'll wrap it up on this one. We've got another strong drive, 4 bars straight back down. Let's say, as an example, a seller sold above that last bear bar right here, but remember their stop is above the highs. Originally, their targets are going to be as a scalper's objective right there. But you'll notice as the market is going against them, they also have other alternatives. Remember, these are build-in traders. So when it gets down here, let's say they take 80% of the position off. Well, they still have 20 contracts to run, so what next? Right? Maybe settlement. Sure, that's a very obvious one, but let's look at something else. Let's look at a 2 to 1 actual risk. Oh, all of a sudden it starts to make sense. See, it's all funny when, you know, it's all super nice when all the pieces come together and it starts making sense, isn't it? We get the 2 to 1 and we know that where's their next target? They got the 0.5 to 1. Awesome. Now what? 2 to 1. We also have that lined up right on top of the settlement and right on top of the previous closes. There's going to be a lot of people taking profit here. Not just these sellers, but sellers for all kinds of different reasons. What better spot to look for your objective to get out of the way of a potential bounce? And sure enough, that thing did bounce almost all the way back up to the break-even point. So just something to keep in mind when you have an incredibly strong push in one direction, especially when it's right out of the gates, right at the open. Remember, 20% of the time you get that really strong drive and you can get that thing going for some really strong setups. Hopefully you found it useful, interesting, and something that maybe you can find useful in your tool belt. Of course, if you have any questions, you can shoot me an email, jhb@ssftg.com, or you can drop them in the comments right below there, right below the video, rather. So have a great one, and we will talk to you in the next. Thanks.